We saw inflation skyrocketing, we saw rates skyrocketing, the dollar going up, and then suddenly the whole lot unwound as the Fed over-tightened and the economy collapsed. And as I said, it went from 56 on the ISM to -30, the fastest recession we'd ever reached, one of the deepest recessions since 1929, 1930, 1931. The crypto story is still a technological adoption curve. It's still Metcalfe's law. It's a slow year for adoption. But adoption's actually been sideways. People haven't left the crypto ecosystem like they did in 2018, which is why we've had a much more of a sloppy sideways range. And I think that adoption continues. And if it continues this way, by the time we get to 2030, we end up with 5 billion people or 4 billion people using crypto. This chart's actually been updated since, and we found that the rate of adoption was even faster. Last year, we had about 186% rate of adoption. You can see what that's like compared to the internet. Overall, it's about twice the speed of internet adoption, and that's truly extraordinary. And it tells us that going forwards, even though the internet, as it becomes a more adopted network, the rate of growth comes down, but the numbers become huge. And that's what's important to the valuation of the market cap of crypto. So again, if we look at these updated numbers, even if we assume some slowdown, whether it slows down by the same percentage change that the internet did after year 6, starting at 5 million users, took year 6 after that, it started slowing down to 43%. If we adjust it by the same amount, we get to 76% growth in crypto. We still get to 2.8 billion users in the next 4 years. If we slow it down to match that of the internet, we get 1.2 billion users. And the internet at that stage was at 500 million. So you can see the dramatic increase. And this is what increases the value of crypto. This is Metcalfe's law. This is network adoption. And what we're also finding is technology, each one at a time, comes at a faster speed. So Bitcoin's adoption was extremely rapid. Ethereum has been much more rapid. And I think some of the other layer ones like Solana have been even more rapid than Bitcoin. And I expect that to continue because the base layer was there. Bitcoin was adopted so fast because the internet existed. Ethereum was adopted so fast because Bitcoin had existed and had been adopted. And the same with the other layer ones. Same with NFTs, which were even faster in adoption. So the market is currently obsessed by inflation. It's obsessed by the central banks. It's obsessed by interest rates going super high. We saw Bill Ackman out yesterday saying, interest rates need to go up to the moon. I step back from the narrative and start looking at, okay, what is the reality of that? And I think the reality is, and I'll show it in the presentation, that what we've actually done is utterly destroy demand already. We've had the largest rate of change of interest rates in history, the largest rate of change of commodities in history. We've had the largest rate of change of mortgage rates, all sorts of stuff, a very perky dollar as well, a strong dollar. That makes a big difference to this. Those things tend to be financial conditions tightening. We can see it in the equity market. We can see it in the housing market. You can see it in the crypto market. Conditions have tightened dramatically. The market's still looking at the previous CPI prints, and CPI is a lagging indicator. The forward-looking stuff of the business cycle is collapsing. And that's interesting to me because that fits with my secular framework, which is disinflationary, slower growth over time, with this aging population, demographics, all of this stuff all coming together. So that's why I'm really paying attention right now. I think the market's probably wrong, and I think that it's going to set up for a whole bunch of opportunities as the Fed pivot fast and the economy goes into recession much quicker than anybody expects. My thesis is demand destruction is what's going on now. Most people have a tendency, economists, people in the commodity markets, most people tend to look at supply. So we know there's a lot of supply restrictions in commodities right now, but people don't realize that the other part of the equation is demand. So most people assume demand is stable and supply is the variable. And I find that demand tends to be the bigger part of the equation. So even if the supply situation is very tight, if demand has been destroyed, then the picture can change super fast. And we've seen it many times in the past, whether it was the 1970s and how people look at money. People look at money supply. We hear that all the time. People don't look at money demand. And money demand is the real thing here. And money demand we can often see through things like velocity of money. That shows the demand for money as opposed to the supply of money. And if there's no demand for money, it tends to be a deflationary or disinflationary environment. If there is demand for money, then it tends to become inflationary. And we haven't seen that. Now, let's talk about demand and where we are in the business cycle. The business cycle is looking like it is about to roll over really, really hard. And I talked about the massive monetary tightening we've had. This is the biggest monetary tightening in all recorded history in the shortest period of time. We've got rising commodity costs, rising interest rates, and a strong dollar. Those three things together are extraordinary. So here is a combination of those three against the ISM, and it's already pricing in a recession. ISM below 47 is a recession. It's saying the 9-month forward ISM is going to be 37, and it's still going. So it kind of feels that we're going to go into a very sharp, urgent recession, and that's what the markets are picking up. That's what crypto's picking up. That's what equities have been picking up. Equities are currently pricing the ISM on a year-on-year basis at around 49. So they've got further to go to price in some of this, but the comparisons get easier because the market went up a lot this time last year going forwards. So I'm looking closer towards the low, and I'll come into that in a bit. And if I look at it another way, people tell me that the financial conditions aren't tight enough yet. Financial conditions here on this chart are inverted. But financial conditions lag. They lag things like this year-on-year rate of change. And the financial conditions here on this chart are telling us that we're going to see a massive move. Now, this chart is cut off at a 300% increase in rates because of scaling effects. It will tell us we'd have the most tight financial conditions in all history. And we can use a number of these charts against it, and they'll all tell us the same thing, is we have massively over-tightened. And that's without the Fed doing much. That was just the markets doing it of their own accord as the inflation narrative took hold. So the markets have done their job. They've killed inflation, but they've given us a big recession in exchange.
That's it for today, guys. If you found this video useful, then don't forget to like the video and share this knowledge with your friends and family. And don't forget to check out the full video, link is in the description. Thank you.